Good afternoon, ladies and gentlemen. My name is William H. Thompson, CPA, MBA, and I am the founder of RE Accounting and Tax Professionals. We help real estate investors maximize return on investment through expert tax strategies, while at the same time helping them to build and sustain a legacy. Welcome to Free Information Friday, and today I'm going to discuss the tax consequences of selling your rental property. Now, this is going to be a basic introduction, so it's going to take into consideration no strategies or no improvements to the property. So let's begin. We need to know a few things first before we can determine our tax consequences. So number one, we need to know what we paid for the property. Number two, we need to know how much we're depreciating the property each year. Number three, we need to know the selling price. And number four, we need to know selling cost. So let me do this by an example. Let's say that I purchased a property for $100,000. That's our purchase price. So let's begin there. So the first thing that I need to do is determine what my depreciation is each year. And then we can determine what our cost basis is. So let's say, like I said, I purchased the property for $100,000. Let's say $10,000 of it is land. As we all know, you cannot depreciate land. So we're going to take the $100,000 and subtract from it the $10,000 of land. So that gives us $90,000 depreciable base. And we're going to also say that this is residential real estate, which is depreciated over 27 and a half years. Okay, so if you take 90,000 and divide it by 27 and a half years, you come up with about $3,237. But for this for the purposes of this demonstration, let's assume that it's $3,200 a year. All right. And let's say after 5 years we decide to sell the property. So that means that we have 5 years worth of depreciation. Okay. So you take 3,200, multiply it by 5. That's $16,000 worth of depreciation. Why is that important? Because it helps us determine our adjusted basis, which is very important when we calculate gain. So our adjusted basis in this situation is the $100,000 of original purchase price minus $16,000 worth of depreciation. So we have an adjusted basis of $84,000. Now let's say, as I mentioned, let's say at the end of the 5 years we're going to sell the property. So we've determined what our cost basis is and what our depreciation is and our unadjusted basis. So now let's determine what our selling price is. So let's say the selling price is $150,000. And for these purposes, let's assume that selling cost is 5%. So I'm going to take the $150,000 and multiply it by 0.95 to get what the actual net of selling cost is. And $150,000 times 0.50 is $142,500. So we know what our adjusted selling price is, and we know what our adjusted basis is. So you take the $142,500 and subtract it from the $84,000 worth of adjusted basis. So that gives you a gain of $58,500. But we're not done there yet, because as I mentioned in prior videos, there's such a thing called depreciation recapture, which means that for the depreciation that you've taken on the property, you have to recapture that up to a maximum of 25%. So let's take the $58,500 and subtract out from that the $16,000 that's subject to depreciation recapture. Leaves you $42,500 of long-term capital gains, subject to long-term capital gains. And what I mean by that, because we held the property for more than 1 year and 1 day, we get the benefit of long-term capital gains, which is a maximum of 20%. So let's calculate our tax, if you will. So let's take our $16,000 worth of depreciation and multiply it by our, what is it? Yeah, the 25%. That's going to be $4,000 worth of tax on the depreciation recapture. Now, we need to know what our long-term capital gain is going to be on the tax, or the long-term capital gain tax will be on the $42,500. Now, let's assume one other thing for hypothetical purposes. Let's assume that your adjusted gross income is over $250,000. Now, what does that mean? It means you're now subject to the net investment tax, which is 3.8%. So let's say that you're in the highest long-term capital gains bracket, which is 20%. You got to take the 20% and add 3.8% to it. So your $42,500 is going to be taxed at 23.8%. So let's do the math on that. 42,500 times 23.8% is $10,115. So you combine the $4,000 of tax on the depreciation recapture and the long-term capital gain tax coupled with the net investment tax, it's $10,115. So your total tax on the property is going to be $14,115. What does that leave you with? It leaves you with your $58,500 minus $14,115. It's going to leave you with money in your pocket of $44,385. And it's very important that you do something as soon as you can with that profit, otherwise it's going to get eaten up by inflation. I'm going to cover that in another video. So I hope this segment of Free Information Friday was helpful to you. And if you're a real estate investor who wants to maximize return on investment through expert tax strategies, while at the same time helping to build and sustain your legacy, book a call with our firm. And remember, only you can create your empire, but we are here to help every step of the way. Thank you, and I wish you much success on your real estate journey.